Bryan emailed me 3 quick questions. One of those is he's tracking a position in power options and he's going to be assigned. I assumed it was a covered call. I didn't look at his portfolio. It could have been a naked put position that he's allowing to be assigned, but it could be a bull call debit spread too. But he asked, how do I account for that on the power options portfolio? Just close the position this afternoon. No. In the portfolio, we have it programmed in that once you enter a position in the portfolio, you can click on the Edit More Information button here, the little blue buttons next to the position. If I'm in a covered call, I'm going to click the button next to the call, go to Position Actions, and here I can just close the leg. I can delete the leg. We can roll the leg, expire all options if it's a spread, or exercise or assign. And what that will do is it'll take you to an entry where it knows you're going to be assigned on the call. So you're going to sell 100 shares of Starbucks at $83. And the 60-cent premium's already accounted for in your portfolio. So that's just the easy way to do it. I did answer by email, but just using the more information, whenever you want to make an adjustment in the portfolio, you've got a married put and you want to add a covered call to it. You've got a bull put credit spread or a bull call debit spread and you want to roll it. Use the more information button, go to Position Actions. If it's a covered call, use the one from the call leg, not the stock leg. And then you can choose to do whatever adjustment you want, close it, close the entire position. You could do that as well, Bryan, but it's easier to use the correct one, exercise and assign, or expire the leg, roll the leg, and so forth. Okay, so quick one there. We might take a look at that in action in a moment too. Second question, sort of related to what we just discussed. Bryan said, I believe several weeks ago, you said bull put spreads are your preferred method for consistent weekly profits. From 2015, as I mentioned, to even 2021, I was consistently trading bull put credit spreads. And for the first 6 to 8 months, I was tweaking the criteria that we have, the weekly bull put criteria that we have. This was designed similar to be sort of like Ernie's picks of the day for covered calls weekly and monthly, and the cash secured or naked puts picks of the day that he created the criteria and back tested. And obviously from 2015, mid to late 2015 to 2021, with the exception of what was in 2022 and what the market sentiment told us, it was a very good time to be using bull put credit spreads. And these structures that I made and the criteria that are there, the decision-making process of rolling and adjusting, were all based on trading, testing, and going through that multi-year process to what worked out the best, and then going back, making a subtle tweak and seeing if it would have worked better. Okay. But it did really well for me and I like it. But we discussed this last week, as I mentioned in that presentation on expectancy. Even with the market rally up, I do not know if right now is the right time to jump back into bull put credit spreads the way that I traded them. During our discussions of what strategy you're trading right now, we had 3 or 4 of our regular webinar attendees, Chuck, Steve L., I believe, and Jim A., who said that they are doing bull and bear credit spreads, and they have their own criteria and some other tools that they use for the analysis on that. And you can see those presentations, of course, on YouTube. But again, as I mentioned, I opened the 7 bull puts in February, had to manage 3 of them, opened a couple more recently that are doing extraordinarily well because the market sort of did what it's been doing for the past 4, 5, 6 days, as you can see. And this is SPY. This is where I want things to be to enter into bull puts. Why am I saying that I'm hesitant? Because I remember what happened in June. This started to look really attractive too. This does look more attractive, Bryan, I'll admit, than what we saw in June. But just one little thing, 2 little things, 3 little things came out, and they're pretty significant. And that just would have taken everything out that was entered over here or even back here to at least the 50% loss, if not more, with that sudden movement. So yes, Jim A., had mentioned in the last discussion on what more strategies are we trading in this market, that he's been trading for many years, and so far this has been the most difficult for him to manage and consistently make profits, but he was still doing well on those scenarios, okay? And that's going along the lines of, you can still make money in these type of markets, but I'm not sure right now for the 1 week or 2 week out premiums that we were looking for the strategies, Bryan, if I'm going to go into those. Right now, as we've said in other presentations, it's still got the bulk of the portfolio in protected married put positions. I have been buying, again, some calls and puts on various ETFs as earnings are coming out, which sectors are doing well, which sectors are doing poor. It's mostly calls this time, where last earnings session we were buying puts on the retail ETF and things of that nature. And of course, the strangle positions on SPY, which have been working really well, meaning that, an out of the money long strangle position with a portion of the portfolio, as you hit a bottom or think you've hit a bottom, then you restructure the strangle. And then when you think you've gotten to a top, you restructure. It's essentially just rolling out the strangle each time you hit a profit target on those positions as well. Okay. And related to that, let me see here. I'm sorry, this is Kip. Kip says, did you ever release an education piece dealing with the bull put credit spreads? I recall you say you were working on something. Oh, yes. Here's the trick. That is about 95% done. And I haven't released it yet because it was essentially 95% done sometime around mid-January. And the market was already going down, and we saw what the markets were. And to tell you the truth, even though my job is to make educational products, educational videos, and Ernie would like to have another product available, I don't want to have that up with people thinking that, hey, this is going to be a great product to buy, which it will be, Kip, but at the same time, it wasn't the right time to release that product because no one should have been trading it. Not just my strategy. No one should have been trading bull puts in general during a certain market conditions of February, and then going into March decay, coming back up in April, and then some other disasters later on. So it was a better time to wait for a more consistent market to get better sales. No, I'm kidding, Kip. It just makes sense for a better market because I don't want to dupe anyone to think that, hey, and it's talked about immensely in the product, Kip, that there's a right time and a wrong time to do a bull put. There's a right time and a wrong time to do a bear call. The last 5, 6, 7 months have not been the right time to consistently assume that you could make money in bull puts just putting on the trade, even following the management techniques. And again, usually I was opening 3 to 4 trades a week. I've only done 7 so far this year. Well, 9 now. Okay, I've done 7 and had to manage 3, and 2 of them are open until next week. So it hasn't been the right time. But yes, you'll see that sometime soon. All right, question number 3 from Bryan. Time decay options over the weekend. There seems to be some varied opinions on this. Comment, please. Well, my answer to him was, in theory, one would expect. And we have seen decay over the weekend. I saw that regularly when I was trading the 2-week out spreads, both sides, bear and bull. But there are so many factors that go into the time value, really what's called the extrinsic value of an option, that could easily appear the opposite. If I have a position, let's say, that expired today, and I had opened it 10, 15 days ago, and I expected some time decay from last Friday, the 22nd, up until Monday, the 25th, well, any slight change in implied volatility from Friday to Monday, or if the stock moved up or down by only 50 cents, would affect and change what I'd expect to decrease potentially in the time value. Those could increase the extrinsic value really at, out, or even in the money options. From Friday to Monday, if the stock remained exactly at the same price through most of Monday's open from Friday's close, there was no change in implied volatility in the individual option itself or the volatility indexes in VXX, VXX, I should say, then you would expect a reasonable time decay. However, that is rarely the case, as those factors influence extrinsic value and are always in flux. Now let's take a quick look. We're going to navigate over to Power Options real quick. And we're just going to look at a Black-Scholes calculator for what we'd expect to see on a standard decay of a position over a weekend from one time to the next. There we go. All right, so here we're now at the main Power Options screens. And let's just go to an option chain. I'm going to use Starbucks here. Just want a minute. We're just going to look a couple weeks out in time. No, I'm sorry, option chain. There we go. All right, so we're not going to look at today. We're going to go ahead and look at next week, August 5th. Let's take, where are we? Okay, we're at 84.78. So we're going to use the right at the money 85 strike. I shouldn't use this stock. I do apologize. Let's go back. Let's use Amazon. These are highly inflated. Well, no, you know what? I'm going to stay with it. I apologize. I'm going to stay with it. So the 85 strike here is priced at 231. It's right at the money with 7 days to go. That seems pretty pricey, isn't it? Well, the IV is at 0.51. The reason why is earnings are coming out on 8.5. So let's just go to the Black-Scholes pricing model. Go to calculators and Black-Scholes. Now here's showing the expected time decay over time on the position. But as we scroll down, we see the daily time decay effect. The expected call bid on option 1, and it's 159, and that's because the volatility did not transfer over. This is 0.551. That's what we saw, 0.515. I'm sorry, I believe. All right. There we go. Okay, so that's closer to where we were, where we just saw on the option chain, the 233. So essentially, if everything stays the same, if Starbucks remains right at 84.75, right at 84.78, the implied volatility stays right at 0.515, we would expect a time decay over the weekend. I'm sorry, it's here, of almost 60 cents. And then more rapid decay as we get closer to expiration. That's the expectation of what we'd want to see. Now, if the stock goes up on Monday, let's go to 85.50, the 50 cents I mentioned. Remember, we were looking at 195 expected time decay. I'm sorry, 173 on Monday, 8/1, 60 cents a time decay expected over the weekend. We get a 50-cent gain, and it's at 211. Would only be a 20-cent decrease in time premium with a subtle movement. And if the stock moved up and volatility kicked up a little bit more, because now we're only 4 days away from earnings, what would we expect on August 1st? From our price of 233, it'd only be down 10 cents to 223. The price is always going to be in flux. The volatility is always going to be in flux, and that's going to affect more of the expected time value decay than just passing 2 days of non-trading. But yes, in general, you're expecting to see some time decay on the position, even here with a 50-cent increase and a little move at implied volatility of 0.04. We're only losing 10 cents from our 233 price right now, where it would have been $1.73 if everything stayed the same. So Bryan, check some of that out. Go to any option that you're researching or any option you're following. Go to the calculators from that more information button or from the option chain and go into Black-Scholes and then just make subtle changes to the expected price of the stock and see what would happen after 2 days or 3 days, maybe even some subtle changes down or up in implied volatility to see how that affects it as well. All right, fantastic. Now, during our discussion a little bit back there, it's perfectly fine, and we can do this structure here. Dave asked a question, can you show us how to set up a strangle? Let's see what mine's looking like right now. This is the Starbucks covered call that we used in the example, where if I want to assign it, I'll just go to exercise assign. We'd do the same thing if it was a naked put that got assigned. If I had a married put that I'm closing, that I allowed to go to expiration, and I'm exercising the put, use the more information button, go to position actions. You can do all of the adjustments here. And I'm going to do this first, Dave. Just give me one moment. Let's go ahead and exercise and assign. As we saw in the beginning, that gives us the premium that we want, that's already taken into account, excuse me. What are we doing with assignment? We're selling to close the 100 shares of Starbucks at our call strike price of 83. So we go ahead and submit that. Now, portfolio has the profit taken into account, but where's the position? The portfolio view only shows open trades. As you close a leg, roll a leg, buy to back a leg, any closed transactions you're going to be able to view in the analysis by symbol or in the analysis by position view. This one is showing me that I've closed the Starbucks position. We made the 1.3% we expected on the covered call trade for assignment. Let's go to this one here. I don't want to go to April 22nd. I want to go to, that one. So what this is showing me Here, any position that's in red is still an open leg. And any position in white is a position that has been closed, liquidated, rolled, or adjusted. Okay, so when you're in here and I'm looking at all positions, we're seeing all open and closed trades by symbol for that particular portfolio as well. So that's why it disappeared, and that's why it went here to the analysis by symbol or the analysis by position.